is a Dornbusch Partners exclusive event. We're here this afternoon to hear from Michael Glennon. Most of you here participated in the IPO for Glennon Capital. Glennon Capital listed in August last year. It's a small cap manager, and we're here to hear from Michael. He's an award-winning fund manager, and he specialises in small caps and also emerging leaders. And we're very fortunate to have him here this evening. He's been travelling all around the place, and he was telling us today that, I think, was it 39 companies you visited last month? So that's a lot of companies they're visiting, including Capilano Honey, which some of you know is sort of one of my little favourites at the moment. And Michael well and truly put his body on the line. Michael is allergic to bee stings, and even went out to Capilano to have a look how they're travelling despite being allergic to bees. So I think if nothing else, you get an idea as to the commitment of the guy to his trade. So with that, please welcome Michael Glennon.
All right, well, thank you for having me. I flew into your lovely new airport this morning, and it's been very nice up here. And thank you, Andrew, for having me. And thank you, everyone, who came in the IPO and for giving us a bit of support. So I'll just sort of start off. This is a disclaimer. I'm not 100% sure what it says, but it basically says that something about you have to rely on someone like Andrew to get investment advice. So if we can move past all of that. This is what we're going to go through. I'll give you a bit of quick history about the business and myself and the people involved in the business, and then we'll run through a bit about the market and what we do and how we do it all. So I'm not great at following a presentation, so I might deviate a little bit. It's probably a lot easier for you to read on here than it is in the packs there. But if we would just move on a little bit. So I set this business up in 2008. It was amazing timing. It was about 2 months before the GFC hit, so it's not the best time to set up a business. However, I sold the business I had before that, just before the market crash. So I was lucky in one sense, but it took us a little while to get this business going. I've done small companies now for 17 years, so that's all I've done. I don't know much about Top 100, I don't know about BHP, Rio, I don't look at them. I take a very different view to the market. You might see a lot of people coming and presenting to you, and they'll talk about a lot of macro stuff and that. I've got a view on macro things, but it's very simple what we do. We've got 32 businesses in the portfolio, and they're actual real businesses. We understand the businesses, and we go out and we find those businesses. Why we do well is because, as Andrew mentioned before, last month we went and saw 39 companies. We wear out a lot of shoe leather, and we knock on a lot of doors. So we see a lot of opportunities, so hopefully we can put the best of those businesses in the portfolio. And I've got a lot of skin in the game, so I'm the second largest shareholder in the business. So I'm not going to put your money anywhere, I'm not going to put my own money, and I don't like losing money. So they're the fundamental premises that we've got. Maybe if we can just skip over a little bit. So that's a little bit about the philosophy. I take the view about the business. So you guys, if you're a shareholder, we're all in business together. So we're business partners. So if any of you want to ring up and ask me anything, ring Andrew first, then ring me. Because we are quite busy, but we are in business together. So I'm a shareholder in Glennon Capital. You guys are a shareholder in Glennon Small Companies. It's all the same thing. It's a small team, and I'm happy to talk to any of you guys about the investments that we've got and what we do and how we do it. But the other view I take as well is when I go and invest in a company, if the management's not going to give me good feedback and they're not going to have open dialogue, I don't want to have a business partner like that. So I take the view that when we're buying a business like a Capilano Honey, if they're not going to show us through their premises, they're not going to talk to us, they're not going to keep us informed, I don't want to own that business. And it's no different to any of us. If we went into business together and went and bought a coffee shop over the road or any business, you're going to ring me and ask me how the business is going, and I'm going to ring the guy who's running the business, or we're all going to go and meet and we're going to find out what's happening. I take that view with the companies that we've got. So I need to know what's happening, and if they're not prepared to do that, no matter how good the opportunity is, I don't want to invest in that business. So that's the basic investment philosophy that we've got. To put it in context, we're only buying companies that are listed on the stock exchange. So what this represents here is, this is the number of companies just put into a pie chart. So we're looking at the red section. So there's about 2,200 companies listed on the stock exchange. The top 50 is the little black segment. For some reason, we've done a white segment there. That's the next 50. Then the small cap index, which is the next 200 companies by size. This is the total value of the company, is that grey area. We're predominantly investing in the red sector. So it's a lot of work to go out and see these companies. There's a lot of garbage that's listed out there. I mentioned to the guys earlier this morning, we had a business come in 2 weeks ago into the office. This business is trying to value itself at $16 million. 6 months ago, 3 guys got together and they put in $700,000 into this company. Basically, in my view, they're buying stuff that you can get off Alibaba that any of us can go and get, which is like the Chinese equivalent of eBay, and they're capitalising that at $16 million. It's absolute garbage. So we're out there seeing a lot of companies, but we're trying to make sure, we've seen things like this before, it's going to fall over. They call it the Internet of Things. It's a bit of a bubble. So sifting through that, we've come up with 30 stocks that we think are really good businesses. You know, as Andrew mentioned, Capilano Honey, they're real businesses. They're tangible, you can touch them, and they do real things. So a little bit about how we do what we do. So we start off up the top, up here. So we've got this idea generation, and then we create a research agenda, and we go see companies. I'll run you through just quickly. I'm going a little bit quickly because Andrew, I love talking about this because I do it every day. And it's what I do and it's what I enjoy doing, but Andrew's got me on a little bit of a time limit. But basically, for example, Alex that I work with, he downloaded a couple of days ago something like 10,000 data points, 10 million data points of stocks that are listed on the exchange. So what he's done, he's got every stock that's listed, and he's got things like, he might look at free cash flow yield, but of stocks over a few years. So he can filter the whole market and say, look, I just want to have a look at this week stocks that have got a free cash flow yield above 7% and that have had a free cash flow yield above 7% for the last 3 years. So we'll do all different things to try and come up with ideas. So part of it's we generate our own ideas. Brokers will bring us ideas. There's something like 30 IPOs in between now and sort of mid-January, so there's a lot of IPOs, and there's a lot of other corporate transactions, so there's been a heap of reverse takeovers recently. What we do from there is we look at what's interesting, we'll do some numbers around things, and we create a research agenda. And basically that's us doing a bit of desk research, and we try to filter that list down to things that we want to go and see. So we'll prioritise some meetings, and we go out there and we see a lot. We've probably been to, in the last 6 weeks, we've probably been to every capital city in Australia, both Alex and I. And we've seen, I know we added up, we don't tend to add it up that much, but we keep a record of it. It was 39 companies in the last month, so it's a lot of things that we're looking at. From there, when we like the company and we know we're going to go out and see them, we've arranged the meeting, we'll do a bit more analysis. We'll start to do a very rough financial model so we know the metrics. And it's a little bit like the model that we're doing. All this can sound very complicated, but it's no different really to buying a car. A car is an asset that you've got. It's a depreciating asset. We're trying not to buy depreciating assets, but we want to know what, if it's a 5-year-old Commodore, we know it's going to be worth less than a 2-year-old Commodore. It's just to get a rough idea of what the valuation's worth. So we'll go and do some of that. We make sure when we get to the business, we know what the size of the business is, how much debt's in the business, and what the profit's like historically. And we'll try and get an idea about what the profit's going to be like going forward, because we're very much focused on what the business is going to earn. So we'll go to site, we'll see the management. There's a slide, maybe a little bit after this. Out of all those meetings, we generate a lot of fund managers say, look, we see a heap of stocks. So this is how we categorise all of our meetings. So these are analysis that we do. In the first pie chart we've got there, 70% of the companies that we go and see are where we've generated the idea ourselves. It's not like someone's rung up a stockbroker and said, hey, look, can we come in and present to you about this IPO, where they're going to be organising a fee. So, if they're raising money, they'll be taking a fee. So 70% of what we see is ideas that we've generated. In the orange is where brokers and various other people will ring us up and they'll come and see us. And the small grey sliver, that's IPOs. Of those meetings, 85% of these are where we have a one-on-one meeting. It's not where we've turned up at a conference and it's like this, there's one company presenting and there'll be 50 people in a room. We try and generate our own ideas. And of all of those meetings, 73% of them are with the CEO or the managing director, which is an important point. That gets back to that point I mentioned before. When I'm going to invest in a business, I want to make sure that the guy that's running the business or the woman that's running the business is going to have open dialogue with me about what's going on in the business, and I can get to understand the business. So that's not them giving us information that's not in the public domain. That's them telling us about their business. So we've got a good idea about what's happening in the business, and we feel comfortable that we've got good management running the business. So that's if we can go back a page now, that's what we do with the company visits. From there, if we like the business, we'll do a bit more detailed analysis and we'll do a full financial model. We've got a young guy that does that for us, and we outsource some stuff to Vietnam. It's very cheap over there. We pay per hour, $2.85 an hour for the guy that does the numbers over there. It's not high value add. They're basically retyping a P&L on a balance sheet. It saves us time because we're out seeing a lot of stock. So, and from there, we make a decision as to whether we're going to include the stock in the portfolio. And if we're going to include it in the portfolio and we don't have enough cash, is it more attractive than something we've already got in the portfolio? We try to be quite long-term in the ideas we've got. We've held some of the stocks we've had since we set the business up. Things like Certex has been a very good position for us. We've held it for 4 or 5 years, I think. Some of the Dornbusch portfolios have some of that in there. Capilano Honey we've had since it was about $6 when Kerry Stokes went in. We went in at the same time. So we're long term, but we're always looking for new ideas. So, and we just keep repeating that cycle. Every Monday we go through the entire portfolio. You know, sometimes Alex will have seen a stock that I haven't seen. Sometimes I'll have seen something, and so we talk about every single stock in the portfolio and review them all on a weekly basis, what the valuations are worth, what we're going to go see in terms of new stocks for the next week, where we're going to be travelling to. So it's quite an intensive process and there's a lot of work, but it means we keep on top of the stocks that we've got and we're seeing all of the opportunities that are out there in the market. So some of the stocks we saw in the last month, because we do keep a record of all this, we went and saw Capilano, and I actually do have it's a fatal allergy to bee sting, so if I get stung, I'm gone. We went and saw 1300 Smiles. They were down in Sydney. Cenex Energy. This is not all of the stocks were there. I wasn't particular about holding stuff out, but Alex, who works with me, thinks it's his IP and he doesn't want to be showing everything he's looked at to some people because he might want to buy something. But there was a lot of stocks. Metals X, we went over to Perth and saw HFA, is a Queensland business. Austral Ships, which I'm not sure if any of you get our newsletter. We wrote up Austral Ships. It's an amazing business. It's a WA-based business. Things are going very well for us. They're building what's called the LCS class ship, which is it's a big frigate for the US Navy. So they've got an operation over in the States. It earns revenue offshore. And if you just have a look at the picture of one of these boats, it looks like something completely space age. The US government's going to build 50 of these boats. These are massive things, and there's ongoing annuity work for them. Plus, you know, the Australian government's got issues with our marine fleet, so they're well positioned to get that work going forward. So that's a business we really like. It's not that expensive. It's got a little bit of expectation built into it, but we've held it for quite a while and it's done quite well for us. This is just a bit of background on myself and Alex. We're the two guys running the portfolio. Alex is completely competent if something happens to me. I've known Alex for 10 years. We actually shared an office together. He worked for, some of you may have heard of Cadence Capital. So Cadence and I were all on the same floor. But he's just done small caps as well. So he was at Cadence, then he went to Atom Funds Management, which was just a small cap business, got taken over by 8 investment partners. 8's been running around doing a small cap fund at the moment, some of you might have seen or not seen. So he's a good guy, and I've been doing small caps for, as I said, 17 years. Prior to this business, had a business called Adam Smith, which was the one I sold just before the GFC. They weren't real happy, but you know, contract's a contract. And we won Fund Manager of the Year at that place. I worked with a guy called David Paradise before that. He's probably a very well-known small cap investor. And I was MD of another business that we sold to Sol Patterson's before that, which became their funds management business. Tom Milner, who runs the Sol's funds management business, was my old analyst. I hired him 15 years ago. And we still get on quite well with the Sol's guys. So that's a lot of my background. But the unique thing about it is it's all in small caps. There's not that many people in the market that have been doing small caps exclusively for that sort of length of time. People move in and out. In terms of the business, we outsource everything. I'm not good at managing people. I know that. I like it to be a bit quiet in the office. I don't like people coming up to me and pestering me about settlements and trades and things like that. It irritates me. So we outsource everything. So we've got 2 guys at White Outsourcing. I've used White Outsourcing for about 15 years now. They just specialise in investment administration. So they do that. The accounting for the listed funds done by White's as well, and audited by Pitcher Partners down in Melbourne. How's our guy in Vietnam, who's, you know, as I said, if he's a bit slow, it doesn't really matter at $2.85 an hour. And we've got Amy works for us doing our accounting, and we outsource the IT. So it's a small operation. It's quite efficient. You know, I had 20 people working at Adam Smith. It's very inefficient. You can't make good decisions by consensus in small caps. In terms of the listed vehicle, GC1, we listed on the 21st of August. We've been quite happy with how things have gone. Given that the market fell dramatically, that was a Friday, and on the Monday, the market was off 4.5%, so it was a pretty big fall. But basically, in terms of structure, we invest in between 20 and 60 small companies. The number of companies varies roughly depending on economic conditions, and you've probably all heard that saying that, you know, when the tide's rising, all boats float, and it's a little bit like that with the market. It's easy to find stocks that are going up when the economy is doing well and, you know, everything's going up. I don't think it's that type of market at the moment. I think you've got to be very selective about the stocks that you pick. You can't just sit in anything that's going to go up. So we're down at the lower end. We've got 32 stocks in the portfolio at the moment. If the economy is a little bit more buoyant, we'll end up owning more stocks and diversifying the risk, but it's harder to find more stocks in this market. You've really got to be quite selective about what you're buying. I'm the second largest shareholder in the fund. The largest shareholder is Jeff Wilson, who some of you might have heard of. He runs Wilson Asset Management, so he's a good friend of mine. Obviously thinks I'm a competent guy, which is good. Probably not as important to you, the different platforms that you can get buy this fund through, but because Dornbusch has got their own platforms that they'll use. We're recommended by independent investment research. There's a recommended investment rating, which is their second highest rating that they give out. And the directors of the fund, it's quite important I mention who these guys are. John Larson's been a friend of mine for a long time. John used to be head of equities at Mercantile Mutual back when it was Mercantile Mutual before it was ING. Then he ran Bain and Company before it became Deutsche Bank. So he ran Deutsche Bank in Australia for a few years and retired, as you do when you make a lot of money. But John's been a very good friend of mine. And he's a very significant investor in the market, both in listed and unlisted stocks. And Gary Kroll is the MD of a financial planning group who's been a supporter of mine for about the last 10 years. So he represents probably about a third of the shareholders on there, so he keeps me pretty honest. And Pitcher Partners are our auditors. Just in terms of where we sit now, when we started, the net assets, so the net tangible assets, the NTA, was 97.1 or 2 when we listed. And this is only from, these numbers are as at the end of October because we haven't released the new numbers yet, so I can only give you what's been released already. And that'll be coming out in the next week, but things are going well. You can read into that what you like, but we're already up 5% in terms of performance since we listed, from the 97 to 91.5 on a pre-tax basis. We have already created a provision to allow us to pay a dividend, so we put a profit reserve and we swept the profits into the profit reserve. So this will be paying dividends. I'll be exercising my options over the next 12 months. And I definitely want a dividend as the second largest shareholder. So I'm sure all of you want a dividend as well. So we're all in the same boat. The ticker code's GC1 if you want to have a look at it. Share price at last close, I think it was closed today at 99 cents, but you know, it's close to what we listed at. But when you bought the shares in the IPO, as most of you would have done, you got a free attaching option. The options are trading, I think they're about 2 cents, somewhere around there. I don't keep that close an eye on it. But together with the share price at 98 and the option, you're just up in terms of the share price performance. But the underlying fund has significantly outperformed that in the 2.5 month period. And the market cap of the shares and the options is about 21.3 million, like diluted options. In terms of the portfolio that we're holding, there's 32 stocks now. We exited something in that period past there. 35% of the portfolio was in cash. It's down to 30% now. And the median value of the businesses we've got in the portfolio is just under $400 million. The top 5 positions, I'll give you a quick rundown because some of you probably never heard of half of these businesses. Silver Chef is the largest position in the portfolio, and it's a financing business basically for restaurants and catering business. And you know, when you go into a restaurant or a cafe and there's all that stainless steel stuff, that's how this business started. So rather than setting up a small restaurant and putting $200,000 into fridges and stainless steel, these guys will finance all of that. It's a very low risk business because there's a very big aftermarket for secondhand stainless steel stuff. And they've expanded past that, but it de-risks the whole proposition for someone setting up a restaurant, because instead of you having to have $200,000 tied up now in stainless steel stuff in fridges and stoves and things like that, now you might be spending $5,000 a month. So you've got a lot more working capital because you've financed all of this stuff. The only time Silver Chef loses money is if someone goes broke in the first 3 months of them financing the equipment, which rarely happens because now they've got a lot more capital. And they've expanded offshore. So the guys in the business, Alan English is the CEO, major shareholder, very passionate guy. We've been in the stock for a very long time. It's been done very well for us, and we think that it'll do just as well in the Canadian market as is what it's done here. So that's Silver Chef. Certex Medical, as I sort of mentioned earlier, I don't do a lot in biotechs. I'm not a scientist. I don't have the smarts to be able to assess whether someone's drug is going to be able to cure cancer. This is a little bit more developed. It's got something called a SIR sphere, and what it does, it's a treatment for cancer in the liver, and it actually delivers the radiation right to the liver. It's very effective, and it's really got it. I personally think this is like the next CSL or Cochlear. I'm that confident about the business. The shares, we bought the shares in our separately managed account portfolio at about $4.30 or something like that a few years back. The shares got up to $50 mid last year. They came back to sort of $28, and they're sitting around mid-30s now. But it's incredible technology. It makes money, so I can value the business. I understand not the actual science behind it, but the fact that it's got something that's proven. There's research papers you can get from their website. And I like the business, and I think it's a lot bigger business than some of the smaller businesses we've had, but we've had it since it was a very small business, and we understand the metrics that the business trades on. APN Outdoor, it does outdoor advertising, digital advertising. You might see, especially more so, I don't know whether you've got it up here, but billboards and the digital billboards, they do all of that stuff. We're a little bit cautious about that though. There's this fear running around the market about stuff that's, businesses that have come out of private equity. It came out of private equity, it was in Quadrant. We're a little bit cautious because in February we know that the private equity is doing their last sell down, and if you have a look at what's happened with Dick Smith recently, that's a business that came out of private equity. So these guys are very good at pumping that up. We're cautious about that. I think it'll be okay, but it is a concern of mine. IPH is another business that we've done very well out of recently. IPH is the holding company for another company that's called Spruson & Ferguson, the international property lawyers. This business keeps going from strength to strength. It's consolidating that market. It's getting larger and larger, the consolidation of intellectual property. So someone like Coca-Cola will register every brand they've got in Australia. They have to keep going and registering all their brands year after year. And they've done very, very well. And Select Harvest is an almond business. So if you know anything about almonds, there's been a massive drought in California. Australia's 5% of the global almond production. California is 60%. So when you've got the largest market in drought, unable to plant new crops, you've got water restrictions, and you've got restrictions on planting new acreage, it's been very good for Select Harvest. The share price has come off a little bit recently because it has rained in California, and that's what happens with agricultural stocks. They go up and down according to the weather, as some of you are probably aware. But it's been a very good business for us. This is how I won't spend too much time on this, but this is how the portfolio is broken up in terms of sectors. It's quite a good spread of sectors that we've got there. There's not a lot in materials. You'll see up the top, we took one small investment. It's probably the third investment we've made in the resource sector in the last 3 years. The one prior to that did very well, was in lithium, which has got a lot of demand at the moment for batteries. You look at Tesla and things like that, it's flavour of the month, but we're not there anymore. In terms of just the timing, because, as I said, look, I treat the money in the portfolio as if it was mine. I wouldn't do anything with my money, I wouldn't do with yours, and vice versa. So we listed. I didn't spend all the cash that day. The market dropped quite significantly after we listed. But in terms of the returns we've had out of the portfolio, some of the stocks have been quite good, though their contribution to the total return hasn't been fantastic because I was cautious about the volatility in the market since we listed. But the top performing stock these returns are just since August 21 when we listed. So there's been some quite good picks that we've had in the portfolio. Coffee's up 185%, but it was only a 0.5% position. We were still buying, and a takeover bid got made for coffee. It's an engineering business, and environmental services. IPH, as I mentioned, I've been in the market a long time. We were trying to buy IPH stock. I got a bit difficult with the price. We were bidding $3.59. The other guy on the other side wanted $3.60. I told him where to go because I was trying to be cautious, get a good price for the. And the stock's trading at $8.50 now. So for that cent, I should have paid up anyway. So 20 years in the market doesn't make that much difference when you're, sometimes you just get them wrong. BWX, probably none of the men here will know the business that's in this, but some of the women may. It's got a brand in it called Sukun. It's organic moisturisers and things like that. I'm not an expert on it, but I've been down to Melbourne. I've seen all their plant. It's vastly water, but it's got very good margins. But it's done well. We've made 50% on our investment, and that's after considering that we bought more stock after the IPO when it was up 30%. So we're very confident on that one, and it's got massive potential. It's organic. It's a little bit like Bellamy's. It's not exactly the same, but the products are, there's not enough supply of the products, and the Chinese are just going crazy for organic moisturiser and facials and all that sort of stuff. APN's been good for us, as I mentioned. We bought that stock and they upgraded. And Capilano we'd had for a long time, and just for some reason, some of you might be familiar with it, it's a volatile share price. So just on the days it gets pushed down, we pick up a bit more stock. So, it's managed to, in 2.5 months, we've made 40% out of it. So it's been good for us. Now, I'll just put this page in here because, as I mentioned to Andrew, old girlfriend of mine had invested in the fund, and she said, "What's this option thing you've given me? I've got these options, and I don't know what they are." So all it means is within the next 12 months from the 21st of August, or actually I think it's the 15th of August, you've got the right to buy another share at $1. So if the share price is trading at $1.10, you can buy another share for $1. But if you don't do it within 12 months, it's worthless. So it's got a term on it. And to do it, there's a link on, if you go to our website and sign up to our newsletter, on the bottom of every newsletter, there's a link to this page here. And we've just sort of extrapolated. You just got to fill the bottom part out with the name and address of your holding and send it off to the registry and with the check, and they'll give you the share. So if the share's at $1.10, you can buy them at $1. So provided we've made money, which we are making money, your option's in the money and it's got some value. Just in terms of what we think about the economy, look, overall we're not entirely enthusiastic about the domestic economy. We think it's pretty weak. We talk to a lot of companies. We think that, especially on the eastern seaboard, away from WA, it's been weak for quite some period of time. And so the situation is, if you have a look at what happened in the US, they reduced their interest rates quite a long time before we introduced our interest rates. Now they're starting to get a bit of growth in their economy. We didn't, because we had the resource sector, which was quite strong. So there's that lagged impact that's coming through. Because our interest rates weren't low, stimulating growth, we're coming out of that sort of trough after the GFC a little bit later than everyone else, and the resources have dropped straight off, and we didn't have that stimulatory effect of getting new investment in business to push the economy along. So what I think that means is the interest rates will stay lower for longer, but long term, the economics of it is, it's got to be positive for the economy. Basic economics tells you that if you've got low interest rates, virtually at these type of interest rates, nearly any project that you want to debt finance is profitable. If you've got a 10% interest rate, it makes half those projects not viable. So basically, anyone that can borrow money for any type of project that's got some sort of commercial merit is going to be making more money with low interest rates and higher interest rates. We still think that banks are going to struggle a little bit gaining extra market share unless they start to look offshore. But I think with where the dollar's at now, it's going to be hard for the banks to get growth offshore. And as I said, I've said a couple of times, the tide's not rising. You've really got to be very selective about the businesses you own, which is why we've only got 32 stocks in the portfolio at the moment. The other thing we're very cautious of, and I've been cautious for a long time, we try not to fall in love with any business because things can change. So there's this sort of key word everyone's using at the moment, disruption. But if you have a look just at these sectors we've got here, and so you see in the telcos, Telstra loses market share, and there's all these new apps that come along like WhatsApp. I went overseas a couple of weeks ago, and I can ring people on WhatsApp, and it costs me nothing. I get free Wi-Fi in the hotel, so no one's making any money out of that. Telstra's not getting anything from it from traditional phone calls. Hardly anyone's most people just use their mobile now. They're not using the landline. So there's all these disruptive things. We had a shareholding in a company called IPP. And if you think back 20 years ago, if you wanted to buy a house, you look in the classified ads or you walk down to the real estate. And then 10 years ago, everyone starts looking online. You only go to realestate.com to buy a property. So, that's changed. And places like Fairfax, their revenue from print advertising is going down dramatically. Whereas things like, there's all these disruptive businesses like car sales and IPP, which we own the portfolio, realestate.com's taken over. It's the realestate.com of Asia. They had a shareholding in it anyway. It's been good for us. And you have a look through all of these sectors here, Surf Stitch, you don't go to the surf shop anymore, you go buy things online, the iconic eBay. If I want to get something, that whole sort of, middleman is disappearing because you can go to Alibaba and you can buy something straight out of a factory in China for a tenth of the price that you'd buy it for when it used to retail here. So it's really changing the way people shop. Travel, we've got a shareholding in a business that owns a company called BYO Jet. I can get a ticket this is the only one I use it for, but I know I can get a ticket from Adelaide to Perth cheaper on BYO Jet than I can get it off the Qantas website for, because they hook directly into the global booking system. So there's all that retail margin. And Qantas on their website has to maintain the retail margin so that the flight centres and all their other big clients are making some money out of selling domestic airfares. So you can get someone that says, well, look, we've just got some software and we don't need a lot of staff and we don't have a lot of overheads, so we can provide this ticket a little bit cheaper. So things are constantly changing. I know a lot of people have taken up, we've got a small business, we use in our business Xero. My accounting fees in our business have dropped dramatically because my accountant doesn't have to do any work anymore. The bookkeeping role is virtually gone. It hooks up automatically with the bank statements, everything comes back in, and it remembers if I have, when I get a cab and it says from cab charge or something like that, it automatically files that and puts it into the expense account for travel. So it's done, it's reducing costs. So things are changing. That's why you don't want to fall in love with any business, and you've got to keep looking at what's happening in your portfolio. I won't go through the rest of them just in the sake of time, but things are constantly changing. We're looking at some of these new businesses. I don't understand. I think there's a lot that won't be around in a few years, like technology things. There's a company some of you might be familiar with, it listed a year and a half ago. It's called OnePage, $20 million market cap when it listed. Market cap got up to about $800 million maybe 3 months ago. So from 20 mil to 800 mil, fantastic performance. I don't understand what the business does. I went to a presentation on the business, but what I can tell you, $800 million market cap and $200,000 revenue. I don't know how you make money out of that. I don't know how anyone's going to make money out of that. But what I can tell you, I thought, look, there's something going on here that I clearly don't understand. Everyone's a lot smarter than me. So I took the presentation of OnePage and I got on LinkedIn, and I pay for this extra service on LinkedIn, which means I can email anyone. It's helpful for the job. So I got on there and I emailed the 3 chief technology officers of these big public companies in the States that are that OnePage say are clients. And then we have a little bit of dialogue, and great, you're using OnePage, and they love it all. And so I just want to ask you one question. So I got 3 of them that would actually respond. And so I just want to ask you the one question. What would you actually be prepared to pay for the service that you're currently getting for free, which you're obviously getting for free because it's only $200,000 revenue? I didn't get a response from any of them. So I'm pretty happy we don't own that business. Now, in terms of other trends that are going on in the economy, China is diversifying. We just missed out on a transaction. We were looking at putting money into a company that was buying Van Diemen's Land, company down in Tasmania. You might have read about it, got knocked back in court last night. We thought that was a great asset, but it's being sold to the Chinese, and we think that trend is going to continue with the Chinese buying both domestic property in Australia. People in Sydney now, there's a well-known stockbroker, Charlie Aiken. He's got his house on the internet, and there's pictures, and every picture's got, I don't know what it says, but it's got Chinese underneath it, because their view of value is very different to ours. So Chinese people are getting money out of China. They're buying assets over here. People are getting more money over there, so they want to actually consume more. The guys from Sukin, which is the BWX business we have, they're saying that Chinese people come to Australia and they fill their suitcases up with this Sukin product because it's not available overseas. So I think that trend of people from China especially who are getting wealthier, I think that's going to continue, and they're going to be buying more assets over here. So we're looking a little bit in the food sector now, agricultural sector, to get strategic assets, that things like Capilano, things that aren't, Capilano's got such a good market share and market position. It's a strategic asset. And I think it's very hard that, that Kidman sale was knocked back, but probably more for security reasons. It's very hard for the government to knock back some of these things on FIRB issues, because Van Diemen's Land company is already owned by the Kiwis. So how can the government say, look, we're going to knock it back on FIRB because they're Chinese? Well, they can't really. Does it matter whether they're Chinese or Kiwis? You can't prejudice like that. So more of that will go on, and there's just so much money out there in China, and they can pay big prices for stuff. The other thing that's happening a lot, I mentioned I think the economy is quite flat in the bigger end. It's hard for the top 100 stocks, the BHP, to get growth. What they tend to do when there's no organic growth in their business is they buy growth. So we're seeing a lot of acquisitions. So realestate.com buys IPP. Equity Trustees makes a bid for Diversa. INET and TPG moving together. M2, which we were a shareholder of, and Vocus have been moved together in the telco space. Coffee, which I mentioned we had a shareholding, got bought out by Tetra Tech. Broad Spectrum, which is Transfield, you had that bid yesterday from Ferrovial. IPP, realestate.com Vita, Equifax. This is just the last couple of months, and Hub24 had a bid by IWF. So all these big guys start fishing in that big red pond I had up earlier on. So it's a really good dynamic underlying what's happening in the small companies. They're cheap, and if you're picking stocks that are cheap, that are good businesses, you've got the extra benefit that there may be a takeover. We don't invest because we think something's going to get taken over. We buy good businesses. And when the corporates are out there looking to make acquisitions, they're looking for the same type of businesses that we're finding. There's a lot happening at the moment. You can't read this, but that's just off the ASX website. That's all the IPOs that are coming up in the next couple of months, in the next month and a half. So there's a lot of stuff, and it's mainly in that space that we're in. It's all sort of under sort of $250 million. There's a heap of stuff happening in the small end of the market. It's very hot, and the performance has been quite good in some of those stocks. I don't like a lot of them. There's a little bit of bubble forming in some of the technology stocks. As I said, I don't understand them. There's a good chance if you don't understand something, it probably won't work out. I didn't understand a lot back in 99, 2000 with the tech stocks, and none of them are there anymore. They became resource stocks, and now they're not resource stocks, and they're becoming tech stocks again, and they've never earned any money. So we stay away from all that stuff. In terms of the portfolio, this is just a few of the stocks that we've done well out of. We've held this shareholding, and this is what I mean about being long-term. We bought into FSA, which is Fox Symes and Associates. I don't know whether they advertise up here, but they definitely advertise in Sydney, late night TV, after sort of midnight, the slot that no one wants, because Tim Ma, who runs the guy, who's also a shareholder in GC1, I've come to know him over the period of time we've invested in the business. But we paid 37 cents he had after the GFC. He couldn't raise his subprime debt. He couldn't raise any money at all. Ourselves and Cadence took a placement at 37 cents. The shares have come back a little bit now to $1.10. It's having a bit of a breather at the moment, but we've done very well out of it. I think he'll keep doing well. He's very driven. He's a little bit hard to get to know, but that's what you want, someone like that that's running your business, and he's passionate about his business. So FSA has been a very good investment for us. We've held it for quite a long time. It's not expensive. It's on 9 times earnings, which we like, of current multiples. And that's not expensive when you look at something like Domino's Pizza, which is trading at 50 times. My view on stocks and PEs, people argue whether it's a good measure or not. But if you think really conceptually about it in a very simple way, if the business is trading on a PE of 4, and I go out and I borrow, if it's a $100 million company, if it's on a PE of 4, I can take all of the profit from that business and I can own the whole business in 4 years. That's sort of oversimplifying it, depending if it hasn't got debt and whatnot. But saying it's got no debt, it's trading on a PE of 4, in 4 years you can own it. If I go buy Domino's Pizzas on 50 times, I can pretty much guarantee I'm not going to be here in 50 years' time when I've paid off the debt I've had to borrow to buy that business. So you can entirely debt fund a business. If it's on a PE of 4, in 5 years you'll own the business out of cash flow from the business. And that's the way I like to think simply about businesses. So Silver Chef I mentioned before, but this is the share price chart of Silver Chef, the business that does the stainless steel and things like that. It's a great business. It's had its ups and downs, but I like the business. It missed its profit numbers up here. I was not concerned at all. We bought more stock, and this chart looks very much like the chart of Certex. Certex got a little bit ahead of itself when it went to $50. They put out some results. The market didn't like the result. I think the stock was halved, and I actually read the result, and if you take the view you're a business owner, I thought this is actually a good announcement they've put out. Yes, the share price is halved, but it still says everything's going well with the business, just all of the blue sky was taken out of the share price. So we bought more stock, we were patient with it, and within a year it was back up above where it was before. So the market can be very short term. It does affect our performance numbers when things like that happen, but if you look at that chart, that's just a small blip of where we think that business is going to. It's not expensive, it's got offshore earnings, it's got good management, it's a nice business, and it's only valued at $250 million. IPH, as I mentioned, I got a bit stingy at 360 for with the shares, and it's never come back. 1 cent. There's some saying about don't be a something for a cent, but I won't mention it. But it's a big business now. It's $1.5 billion, and this is all built off intellectual property rights. They're making acquisitions, they're moving into Asia. It's a really good business. This is just briefly touch on the performance, because just of this fund, we've only been going since the 21st of August, but you can see the gross return, and this is if you'd invested $10,000 where it would be at now just off the gross performance. So the numbers are quite good for a short period of time. We expect that will keep going because don't think the portfolio is expensive. And if I thought the market was expensive, I'd say, look, I think it's expensive, but I think there's enough good businesses out there out of the 2,200 that are listed that I can find 30 that should be able to deliver for a period of time. So just sort of finally, if you want to follow what we do, we put a few videos on YouTube. If you go to our website, they're also listed here, which is glennon.com.au. You can sign up to our newsletter. We send out something every week. We sort of try to, the people that subscribe to the newsletter, give them a few freebies and tell them what we like stock-wise, with as much as what we can do without disclosing stuff to the ASX. But we also go on the Eureka Report, which is Alan Kohler's thing. We do the LIC update there. We're in Baillieu Holst's LIC research. We've got independent investment researchers covered us. Put all our announcements through the ASX. We've got a Facebook page and a Twitter thing, but to be honest, I think it's a bit of a waste of time. So we don't do much there. And if you want to get in contact, feel free. I stick my mobile number anywhere. If anyone wants to call up, I'm more than happy to have a chat on a stock or whatever. But that's it. Has anyone got any questions? Yep.
You have the best 5 performing stocks.
Yep.
What were the 5 worst performing and how bad were they?
Well, they weren't that bad. So it's just as much about avoiding the losers as it is about picking the winners. Because you look at the Acorn fund listed and it's went from $1 straight down to sort of 88 cents or something like that because they got a couple of unlisted things that went wrong. So we've avoided the things like Dick Smith. We did a bit of work on it because I thought, hey, it could be cheap. All those big stocks that have come out of private equity we didn't like. There's been a lot of things we didn't have any at Rams. When they listed it, it went straight down, really quickly. So we've been pretty good at avoiding the disasters, and we've missed a few of the stellar things like the one page that's gone up 20 times. But I don't understand it. I don't want to put my money in something I don't understand. So, you can say, oh, you're that good. It's not that I'm that good. It's just, I'm just buying businesses. And even if they weren't listed on the stock exchange, I was here and I walked down the main street and I said, I'm going to buy the 5 best businesses here. I'm sure you could do the same if you're spending all day doing it. I'm spending all day doing this every day, and I've got guys helping me doing it, and I've been doing it for a long time. So when we're avoiding the disasters, we've been around long enough to know business models I think will work and won't work. As I said, I'm cautious on the APN outdoor because I've seen it time and time again. The private equity guys pump it up, they get their last bit of stock out and the stock falls apart. So we're cautious on things like that. So, we've got that stop loss in at 20% and we'll sell it if we can't work out why it's going down. Where it's going down and it's just a complete overreaction like the Certex and the Silver Chef at that point in time, we'll buy more stock. We know the business well, there's nothing wrong with it. I was scratching my head with Certex. I kept reading the announcement and read positively.
Michael, I think Michael, Dodie and I would agree that stop losses are very difficult for us to do.
Yep.
We've also pulled in other companies. Mm-hmm. You mentioned 20% is your magic number. How did you come up with that number? Is that just experience or that's sort of enough leaks that if it's not working, you're red for?
No, I think it's a pretty serious decline. It's outside the realms of normal volatility. But you look at something like a Capilano and you just have to accept then on that basis that that's a volatile stock. So it's just a point for us reviewing so we don't sit there. And the reason we do it is because the stock can drift off, and it can drift off over a period of time. And you think, oh, well, it's $20 today and then it's $19 this week and then 3 weeks later it's $18. At some point it gets to that that point where it's off that rolling sort of level. So, that's where we review it. And I think just over time I've gotten to the point where I think 20%'s a justifiable amount to say, hey, look, we got it wrong by 20%. We paid 20% too much or we got something wrong. And we do get a lot wrong, but I try to move on from them quickly. Some things, you'll go and see something and you'll change your mind. You might go talk to a competitor or something and you'll say, hey, I just don't want to be in this business anymore. So, yeah, I don't keep them front of mind. Yep.
Michael, when do you expect to pay dividends?
Well, as I said, we've created a profit reserve, so we've swept the profits into a profit reserve. We can't pay anything before like March next year anyway at the earliest. If we do it, it's a decision for the directors, but there's enough there to pay a dividend now. I haven't worked out the exact amount. I just took all of the profit and I put it into the profit reserve as a prudent thing to do so that whatever happens with the market, we've got the ability to pay a dividend before up to 30 June next year for this year. So, yeah, look, it's there if we want to do it. And I want to do it, and especially when I exercise my options, I'll have $1 million in here. I definitely want a dividend off that. So, Yep, I can't tell you more than that. Yep.
You've got almost nothing in materials / mining.
Yep.
anymore. Do you see any niche places where there actually are opportunities in that sector?
Yeah, it was, so I said last year prior to this fund, we had a position in Pilbara Minerals, I think it is, and we took and this is how I like to do these investments. We had a position, we took it as a convertible note, it paid us. I said to the guys, look, I don't like resource stocks, I really don't want to be here, but it's a pretty good deal you've made me. So I said, I'm your lender of last resort, I'll lend you some money. It was a $5 million market cap company that needed $1 million, we put in 200,000 of the $1 million. And that position is now worth $2 million. So that's in an individually managed account for one of our high net worth guys, but that's lithium. So, you know, lithium is fantastic at the moment. We converted the note, it paid us 20% coupon. We didn't take the interest, we capitalised the interest, we converted into more shares and we got options. It's basically, I say to guys, if you want me to lend you money and resources, I am your lender of last resort. I'm going to charge you a 20% coupon. I want a convertible note and I want options. So I'm going to take 40% of your enterprise value for lending you 20% of the money. So if you want to get, if you want to get screwed, come and see me, but I'll lend you the money. And it just so happened though that I knew the chairman well. He knew it was a good deal. He knew they couldn't pay back the interest, and it was low risk. They had a signed offtake agreement with Japanese for the lithium. There was no risk. They just had 6 months worth of project financing to get the plant finished. So it was low risk. I liked it. We've made a lot of money out of it. So I'm not averse to looking at resource projects. I remember when we sold the first funds management business, I had to sell Patterson's. I worked with them for a while. I asked Rob Milner why they sold the Adaro mine in Indonesia. And it seemed like a very cheap multiple to me. And he said, oh, look, Michael, people look, we've been in coal 30 years. People look back in 20 years' time, 10 years, 5, whatever, and they'll say, we've got a pretty good price for this. And so in hindsight now, he's probably right. But, I came back to that methodology. I look at resources and I think they're a commodity and there's no barriers to entry. So I want to buy my resource stock on a PE of 4. I want to make sure that I'm going to get enough cash out of what's in place, the resource that's there, to pay me back if I had to debt fund the whole lot. So it was on a PE of 4. In 5 years' time, I want to know it's got 5 years worth of resource at a pretty conservative resource price, and I want to be able to get my cash back. So,
Are there any agricultural companies in the sort of South Queensland space that will start utilising World Camp airports in Asia?
I don't know, but it's a nice airport. No, I asked Andrew if there's any listed companies I could come and see up here, and he said he listed the history of companies that have been here, but there's nothing here. But we are looking at that, that sort of resource, agricultural sort of sector because of that whole Chinese thing. So I spoke to the corporate advisor this morning that was doing the deal for the Van Diemen's Land company, and I said, well, look, hey, there's another listed stock it's got agricultural assets in it, dairy assets in WA. Why don't we use that to buy out some of the stuff in Tasmania? And anyway, it's a longer term thing, but I do get quite involved because I know a lot of people about trying to push deals that we think will be good for us and we get a good allocation. So it works well for us. We would have done very well out of the Van Diemen's Land thing because the corporate advisors on that were the same guys that did our IPO, which is a friend of mine, which is why I did the IPO. So I think after 20 years in the market, I talk to everyone, I know everyone. So we ask if I know Jeff. Yeah, I know Jeff. I know Matt Kidman. Both of them invested in the fund. Carl Siegling, obviously he's a very good friend of mine. Alex used to work for him. So it's like a mafia, and I know everyone.